Morning, everybody. This is Tim Melvin of the Banking on Profits report coming to you from down here in Central Florida on what's going to be another nice, hot, muggy day. We're going to get a little video done before the dog and I go out for our long walk before it becomes absolutely unbearable out there. Still beats snow and ice, so I'll take Florida every time. We've got an interesting start to the week already this morning, reiterating the fact that Janet Yellen truly does have the worst job in America. They're trying to raise rates over at the Fed, and the economic reports this morning just not pleasant. We've got auto sales down. The Fed's activity index is down to the lowest level since 2014, I believe the report said. And then the durable goods report this morning was worse than analysts expected. So durable goods sales are down. So the economy, it's not awful, guys, but it's not good either. So the Fed governors, and they continue to have the worst job in America, in my opinion, right now. Having said that, several of the Fed governors, including Chairwoman Yellen, are going to be running around unescorted this week, giving speeches and talks, and those always have the ability to move or at least influence the market somewhat. So we'll be watching that very carefully. We also have some earnings reports this week that could give us a little information on exactly how the consumer's doing out there. Nike is reporting, General Mills, Micron Technology, Darden Restaurants, KB Homes, and a few other companies. So that might give us a little guidance as to what the consumer has been up to during the second 3 months of 2017. Then, of course, starting next week, we start to really kind of work our way into the heart of earnings season, and it gets interesting. Towards the middle and end of the month, we start seeing the small bank reports. So we'll see what's going on with the banks in our portfolio. I expect the news to be good. I expect to see more dividend increases, more buyback announcements, positive loan growth, continued strong credit quality. I think we're just in a great spot for the community banks, and I don't think that's going to change anytime soon. The other thing that we have that I'm going to be watching with a great deal of interest is Blue Apron has their IPO this week. Now, I've got some friends that have tried Blue Apron, and they were like, it's okay. That's where they send you all the ingredients and the spices, and you just kind of cook your meal up because I guess you're too lazy to go to the grocery store or read a cookbook. I'm not quite sure how that works. Looked into it, struck me as expensive and really a waste of time because I'm not too lazy to go to the grocery store. There's a Publix about a mile and a half in either direction from the house, so I find my way through Publix once a day to pick up some wine and a newspaper and stuff for lunch and grab some dinner ingredients while I'm there. I'm interested to see how well this is received on Wall Street because this has a pets.com flavor to me. I don't see the business as being long-term viable, much less a hot stock in a publicly traded company. But we'll see. I've been wrong about a lot of these things in the past. Keefe Bruyette & Woods was out last week with their mid-year M&A report. No shock to me or to those of you who are subscribers of the newsletter service. They expect M&A to accelerate into the back half of 2017 and into 2018. It's the usual reasons being cited. New one in there. You are going to see some upward pressure on deposits. That's going to make it tough for the smaller banks because the Fed is trying to raise rates. That is lifting the short end of the curve. Eventually, consumers and savers are going to look at their accounts and say, at least some of that 25 basis points should come my way. And banks are going to have to raise up a little bit what they're paying on deposits. That squeezes that interest margins even further. So if you're a smaller bank already struggling, you're going to be looking to sell. Fortunately, there will be an expanded pool of buyers because all of the large community and the regional banks, just about all of them, are looking to make acquisitions. We have some progress on the regulatory front, which may raise that systemically important financial institutions or SIFI limit from the current $50 billion to as high as $100 billion, or I think Barney Franks even suggested that maybe it should go to $250 billion. That brings a whole pool of buyers back into the M&A pool, and that could spur activity. Political and economic uncertainty is another reason that the bankers cited in the report. And again, you're looking at the smaller banks, billion and under in total assets, are looking around going, I don't know what's going on. It's very hard for me to get a game plan together without knowing what regulatory reform looks like, without knowing if we're going to get tax reform that can make meaningful additions to my bottom line. And I'm tired of playing the wait and see game while the goofballs in Washington run around investigating each other. So I've had enough. I'm just going to go ahead and see if I can't sell this bank and cash out my stock. We are also starting to see, and this has been a struggle the first half of the year, in that sellers' expectations were way above what buyers were willing to pay. Valuations have moved up, creating stronger currencies, again, particularly for the larger community and regional banks. Very strong currency, very highly valued stock enables them to buy smaller banks at the premium valuation that the banks are looking for without diluting their own book value. So, which is something shareholders are really watching for. Nobody likes a dilutive deal, and they even more true today than it has been in years past. So the highly inflated currency makes it possible to get these deals done without invoking shareholder ire, I guess is one way to put it. FIG Partners came out last week, and they kind of looked at loan growth in the community bank sector. They think it'll be decent for the quarter. I agree. I think that some of the bigger banks may continue to see some loan growth. Credit quality is going to remain pretty strong. We are seeing some warning signs in credit cards and auto loans, but it's not severe and it's not spilling over into anything else, although we are watching that carefully. The other thing that we're watching very carefully is those banks that have exceeded the regulatory guidelines for commercial real estate loans as a percentage of risk-based capital. And a lot of them are now trying to move into consumer and industrial lending, and C&I lending is a special thing. You know, you're either experienced at it, you do a lot at it, or odds are you're no good at it. So unless they're buying another bank or buying a portfolio of C&I loans and a C&I team, that's very suspicious activity to me and starts to fall into the category of bankers doing something stupid, which is something we watch for very carefully. Every credit crisis and banking crisis starts with bankers doing something stupid on the credit side. No signs of it so far on a widespread basis. We are watching it carefully, and a growing C&I portfolio from a bank that was not previously heavily involved in C&I, pretty good reason to get the stock kicked out of the portfolio at this point in time. We are 8 years into a bear market. Caution is absolutely called for. Now, on the baseball front, guys, it's been a tough couple of weeks. The Orioles did take a series from Tampa over the weekend. So, but again, we gave up 15 runs in one of those games. So offense is doing its job. You know, you can't say that you have a team-wide problem when you're losing games 15-5. 5 runs is normally enough in Major League Baseball to at least compete for the win. Hasn't been the case for us the last 2 or 3 weeks. We got a tough week coming up. We got the Blue Jays, always tough. Then the red-hot Milwaukee Brewers with Eric Thames and that young crew of players they bought in. So that's that's going to be a tough 4-game set against Milwaukee. And then the Rays come back to Baltimore. So if we can get through this week, I'll feel pretty good about it going into the All-Star break. But if this week looks anything like the last 2 weeks, it's going to be hard to project much happiness into the second half of the season. Now, for my friends out there that are Dodgers fans, you guys have a lot to be happy about. Dodgers are the hottest team in baseball. Unfortunately for them, they're not making up any ground because the second hottest team is the Arizona Diamondbacks. So the NL West is looking interesting. I think the Dodgers will take it by the end of the year if they can get Yasiel Puig to quit taking 30-second home run trots around the base. He could have stopped and had a sandwich on that one he hit the other night. So on the reading front, lots going on here. Finished last week, A Land Remembered, which is a classic book about the settling of Florida and the impact on the environment. Great novel, falls kind of, in my opinion, into the cracker western genre, which as you've watched these before, I love those things. Anyway, great book. If you've never read it, highly recommend it. I know a lot of the schools down here have the high school kids read it just for the history and the understanding of the environmental impact of civilization on things like the Everglades and the Gulf Coast and all that good stuff. Anyway, great read no matter how you feel about all the environmental stuff. Also read Bubble Screen, which is book 3 of the Burnside series by David Chill. Now look, you got an ex-football player, turned cop, turned private eye, based in Florida. What's not to love? Great series of books, a lot of fun to read. Like I said, it's purely recreational reading, but it beats most of what's on television. So a good series of books. Also finished up Palm Beach Bones, which is book 4 of the Charlie Crawford series. Here we have a New York cop who is settled in Palm Beach. Thought it would be nice and quiet, but of course, if it was nice and quiet, it wouldn't be a great book series, now would it? However, it is a very good book series written by Tom Turner. Just a ton of fun to read. Again, better than anything that's on TV right now. Also, just finishing up Donovan, America's Master Spy. Started that about a week ago, and what a great read by Richard Dunlop and William Stevenson. Covers the life and career of William Donovan, the founder of the OSS and Congressional Medal of Honor winner. What a fascinating guy, and what a neat look at not too often explored side of American history. So if you're into history and World War II and spies, and it's a great read, highly recommended. Next up on the list, as much reading as I do of private equity reports, reports about private equity companies, interviews with private equity executives, I have never read Jason Taylor of Bloomberg's The New Tycoons, which is a definitive history of the private equity industry. Never read it, so I'm going to correct that this week, and I'll be reporting back. I expect it to be, given my interest in the private equity approach to investing, I expect it to be a very entertaining and educational read, but I'll report back next week and let you know how it was. Okay, looking overall at the markets, who knows? If you read Barron's this weekend, lots of articles about, overvalued stocks. Beware the second half of how the Hindenburg omen, having to do with highs and lows and how they interacted, has successfully predicted 106 of the last 3 major market declines. Has apparently come back into play, and so we got to worry about stocks because of the Hindenburg omen. Lots of articles about negative view on the market in Barron's, but also about 20 articles about stocks that you should buy because they're going to go up 15, 20, 25, or 30%. Why you would buy a stock it's going to go up 15 or 20% instead of 400 to 500%. I don't quite understand that, but I never have understood that. I like to buy stocks with potential to go up multiples, not just percentages, particularly on the small bank side. But anyway, so it's kind of a mixed bag in Barron's. The Wall Street Journal had an article on the dangers of an extended bull market, and they were talking about protective puts, stop orders to protect the principal of your portfolio, and they even bought out my old favorite as a hedging and diversifying tool, managed futures. Managed futures, in my mind, are a lot like communism. They are wonderful in theory. They haven't worked real well in actual practice as part of a portfolio as a diversification, or particularly as a hedge against a declining market. But it mixed tone in the press, but a lot of caution trying to seep in. I agree with that, but I still don't see what's going to make the markets go down at this point in time. We're going to need some sort of significant event. I don't think it'll be economic or financial, as I said last week. I think it's going to be geopolitical in nature to kind of shake people up and get them selling the stocks in their portfolio. Right now, retail in particular is in this market, I think, is a passive investor. It's much like they've bought every story that Wall Street has ever sold them. Stocks always go up 10% a year. Well, now they're totally buying into the passive investment game. And of course, being retail investors, they're switching from ETF to ETF to find the best one. But a lot of passive money in the market, creates a lot of complacency. So you're going to need some significant event to get the selling started. Once it does start, all that money in ETFs going to have a huge negative effect and could act much like portfolio insurance did back in 1987. But for now, no reasons for stocks to go down. We're going to stay with the course. We own what we own. So a fantastic talk by Manish Prabhai. He did another talk out at Google. For some reason, he likes to go by there and talk to the employees about picking stocks. And he said something that I think is critically important. That when you're picking investments and picking stocks, be unreasonable. Insist on just the conditions that you're looking for. And that's something particularly with banking on profits, we have practiced that extraordinarily well. We're very unreasonable. We have our criteria. We will not buy stocks that do not meet our criteria. So we hold stocks until they reach certain criteria, and then we sell them. We're very unreasonable about this. If nothing fits our conditions, we don't do anything. In fact, we're really good at not doing anything. Our time between trades is probably the longest in the history of the newsletter industry. But so for now, be unreasonable. Stick those stocks on the buy list, accumulate lots of cash until we get some sort of event that lengthens the buy list. I think we only have like 12 stocks on the main portfolio buy list. There's another handful of focus stocks and a small handful of bonus stocks that you can still buy. But when you put money to work, stick to those on the buy list, build up cash reserves. Better days are coming. We did have another takeover this morning. It's an old favorite, Meeting House Bancorp, MTGB. That was one of the original bonus picks in the portfolio. It was one of the 10 tiny banks in the report I did about 3.5 years ago. So made pretty good money on that. I think that's our 6th or 7th takeover for the year. So we continue just rolling along with all 3 portfolios. So stay the course, be unreasonable, hoard cash, and I will talk to you guys next week. Thanks for watching.